Good afternoon, and first of all, thank you to E and Clara having EY and myself to present this afternoon. And first of all, thank you to E and Clara having EY and myself to present this afternoon. And I bet many of you may think, why do I need to talk, or why do I need to listen about taxes? It's a very simple answer: to save money and stay out of trouble. So navigating the future of international tax, and what I would like to achieve in the next 30 minutes is that after these 30 minutes, you understand about how taxes, how tax-driven structures can help your business going global, that you understand about the guardrails governments, organizations are setting. I want to break it down, what it means for e-commerce, and last but not least, give you some takeaways as a conclusion. Now, there's one game changer. The elephant in the room is China. Because in the last decade, China has become a kind of magnet for international globalization and trade. And looking at my home country, China has become, in the last decade, the biggest trading partner for a country like Germany, bigger than all other European countries and bigger than the United States. To give you just a flavor, today there are more than 5,000 German companies doing business in China. Now, it always depends on size, on business, on aspirations. And what I would like to highlight with this slide is, on a very basic level, how can a structure look like for somebody doing international business? And this is based on a company, a merchant who wants to source. And normally it starts with the very easy the easy structure. There is a merchant, there is a manufacturer in China who produces something you want to sell to your customers. So this manufacturers, they, and from the merchant, it goes further on to the consumer. Now businesses develop, they become bigger. You have more products you want to sell. So the volume are exceeding certain thresholds. And all of a sudden you realize you need two things. You need somebody at the place of manufacturing who understands the base of your suppliers. Maybe they are better suppliers, more suppliers. And you need to maintain quality. So you want to assure that the product you receive is best quality, and that's the reason why companies establish subsidiaries in China. A company where you can place people and make sure that you get the best out of China. So that's what I call indirect model, opposite to the direct model. But there's still a kind of in-between solution. If you don't want to go into the complexity here of an own subsidiary in China, you also go for a structure where you just have a rep office. A rep office in China is something which you can do very simple. You do not have the complexity of a legal entity, and still can maintain quality control and the expansion of your supplier base. What I still want to mention, on top of quality control and the extension of supplier bases, with this structure, you can control the supply chain. And now we already are getting in the complexity of taxes, because you can control the margin. Because in this model, you are depending on the cost basis of your manufacturer. Here, you can better control your own cost base. So what does that now mean in terms of taxes? And from a very general concept, we are differentiating between two categories. One is the transaction. A product or a service goes from A to B, be it in one country or more countries, and then having the implication of VAT. You are all familiar from your home countries with VAT. But as soon as it goes cross-border, then we also have customs duties. So that's the transaction part. The income part, you know, from your home tax return, you have to pay income tax. So does companies, they have to pay income tax. And as soon as they go offshore, we are also talking, besides the corporate income tax, about withholding tax. I will come back to that later. Now, let's look at the tax opportunities. So we talked about this basic structure. You have incorporated a subsidiary in China. You pay taxes in China. So basically 25% at the moment. And then you want to remit your profits after tax. And then there is the withholding tax, 10% normally for most countries outside of China. So your business is developing, and so far we only have focused on China. But there are many companies which grow beyond China, which all of a sudden realize, so we're getting so big and we have so much diverse demand, we need to look also at other countries, ASEAN countries, Malaysia, Vietnam, even India. So this, for some companies, it makes it necessary to also look, how can I organize my business for not only China, but maybe also the whole region. And then you are looking at two factors mainly. From a geographical point of view, how easy can you go from A to B? And secondly, you may also look, how expensive will this location be? And I put Hong Kong as an example because Hong Kong qualifies for even three requirements. It's very convenient to travel back and forth. It's close to China. And very tax efficient. 16.5 as at the corporate tax rate. So for revenues until 2 million, you even pay below 10%. Very attractive. And another point of attractiveness. There's an agreement between Hong Kong and China saying, when you remit your dividends from China to Hong Kong, we give you, under certain circumstances, instead of 10%, 5%. So this brings me to, how is this all managed? Because it would be wonderful. No borders, very easy, you do business wherever you want. But we should not forget, behind these countries are governments who want your money, who want the money from the profits you make. And this makes it complex in a way already that governments have to find a way to agree upon how your companies are taxed doing business cross-border. And this is an example of the content of a double tax treaty. A double tax treaty is where two governments find a conclusion on how the business is managed from a tax point of view in country A and country B. So mainly concerned are dividends, interest payments, royalties, and capital gains. Now, we have talked about the opportunities. However, there are also challenges. And coming back to what I have said earlier, that you can reduce your withholding tax rate from China to Hong Kong to 5%. This comes under certain requirements. And the buzzword for us tax consultants is beneficial ownership. Beneficial ownership meaning that the recipient of those dividends is a beneficial owner, and beneficial owner meaning that this company has certain business requirements fulfilled. And with regard to China, it means you need substance, you need people, you need a business in this country and this company. And if you don't have it, then we are back to the 10%. A second thing I would like to highlight and alert you before you start with all those fancy structuring is to look at it from the end. So what is going to happen if you come to the conclusion China doesn't work? We need to sell, we have other plans, we want to get rid of China, but luckily we have this structure. So we do not necessarily concern with China because we have Hong Kong in between. So I just sell Hong Kong, I don't care about China, about the Chinese government. However, the Chinese government cares about you. Because what they do, they have analysts looking at the websites of international companies which are operating in China, and they're giving feedback whenever there is a restructuring, a buy and sell situation. And then China argues the following. If this Hong Kong holding company does not have any kind of substance, so the only purpose of this structure is to save the taxes in China when you drop out, then China says, I completely disregard Hong Kong, I treat you as a direct investor into China, and you will be subject to capital gains taxation in China. Yeah, so far to the challenges, direct challenges. And now coming to how governments react, in particular the OECD. And I already begged for the pardon of Mark that I have to talk about Ireland now, because we both agreed that it most likely was Intel at the end of the 80s when they found a very nice settlement agreement with the Irish government, where in a nutshell, they could do business out of Ireland for the whole of Europe. So in a nutshell, they could do business in Germany, France, the Netherlands, you name all the countries, without paying any particular taxes in those countries, but being very low taxed in Ireland. So the Intel model was followed by Google, Apple, you name them. And this was the triggering point for the OECD to introduce BEPS, Business Erosion Profit Shift. So in a nutshell, what the OECD wanted to avoid is that companies are shifting their profits from a country where there are high taxes going to a country where there are pretty low taxes. And the BEPS regulation is keeping us very busy as advisors. And you should also be concerned about it because, in a nutshell, again, what this is going to mean is that they want to level out the playing field, and there should be a minimum taxation of 15% going forward. What about the implementation? Europe is quite advanced. There are two players which are not yet following suit. Unfortunately, or luckily for you, the biggest one, the US and China. But we expect that this is going to change soon. Another term you should keep in mind is transfer pricing. So transfer pricing meaning that if you have a related company, going back to the example, you have the sourcing company in China and you sell your product from China to France, Spain, wherever, then you have to fix a price at which you sell from your own company in China to your home country or to any other country. And to illustrate, I have talked about the greedy governments, that there are two governments who want the same piece of cake, of your cake. To illustrate this, I want to reflect on the discussions a German company, BMW, had when they 10 years ago were negotiating together with the German government and the Chinese government what will be the reasonable price for a car sold from Germany to China and who should be entitled to which part of the project, of the profit. Germany argued very clearly. Germany. BMW in Munich does everything for the technology, invention, the brand building, the brand maintenance, all done in Germany. The Chinese tax authority, they were leaning back very relaxed during this conversation. And then they said, no doubt about it. All this is true, we appreciate that. However, look at your balance sheet. Look where BMW revenues would be if there would not be a China. So I just want to give you an example. There are two far away edges, but both have valid reasons to argue that a bigger part of the tax cake belongs to me. And this is exactly what transfer pricing means. Because as you can see, there are so many transactions you're having on a daily basis where it would be a reasonable argument for two governments to claim, I need to have a bigger share of this. So this is something you have to keep in mind. And as a matter of fact, this is one of the areas which is getting more and more complicated and also more complex to a reason which I would to highlight here, because we have an unprecedented knowledge of the tax bureau. In particular in countries like China. China has started already more than 10 years ago with a project which they called Golden Tax System. Golden Tax System meaning that the VAT invoice which you had to give to your customer in order to get your money. Without this VAT invoice in China, nothing works. And you had to print it on a printing machine which was coming from the tax authorities and which directly gives the information of your VAT invoice to the tax authorities. So as a result, the tax authority was at the same knowledge level as you as a taxpayer. And this was just the beginning, because today we are talking about Golden Tax 3 and 4. And the dimension of this extension of digitization is incredible, because they're not only talking about VAT anymore, they are talking about corporate taxation, immigration. They want to enable each part of the administration cross China, that on the tip of your finger, they know everything about you. You are going to be completely transparent. And this with a basis of data which is unprecedented, because they do not only have your data, they have your competitors' data, they have a whole industry data. And what does that mean for you? You need to know your data much better than you used before. Because what the government is going to do, give you an example from Brazil, for instance. In Brazil, the government is doing your tax return, and you just have the right to review it and appeal against it. And it may not be excluded that China goes the same way. And the point I want to make here is, you need to be prepared for that. You hardly believe how complicated it can be to control or even to collect your own data. Because many companies have a host of different data management systems, and at the end of the day, just to consolidate this is a huge impact. Now, what does that all mean for e-commerce? basically, everything what I said before is also valid for e-commerce. So we have two countries, we have a potential in between, like Hong Kong. But now the complexity is even getting larger because we have different online sales. So you may not necessarily sell by your own website. You may have a platform doing it for you. We have a different logistic flow, supply chain flow, involving warehouses, normal warehouses, bonded warehouses. So bonded warehouses meaning that you have a warehouse in another country where you import your good, but not, you do not need to pay income VAT and customs duty when you import your product to that warehouse. So as you can see, and also look at the speed which you are all familiar with of the development of e-commerce, the governments they sometimes are desperate because they are following you with the business models which you have, but not being able to grab you. And that's why, again, China has come to the conclusion we need to be faster. We need to recognize also the value of e-commerce for China. And I don't want to bother you too much with this table. I just want to alert you on this complexity, on these different trade modes which China already has defined and has put different requirements to it. So this table actually is only concerned with how you deal with customs authorities, what kind of documentation you have to provide, what is the procedure for that. So as you can see, it's an immense complexity just for customs duties. Yeah, Europe is, Mark has given it as an example, not as fast. Things take a little bit longer in Europe and changes are not that dramatic. 2021 was the last reform of the e-commerce law or e-commerce tax law in Europe. And these are the four major conclusions. So they took away this minimum threshold of 22 euro. This is gone, unfortunately. They replaced it with the euro 150, where you are entitled to a very simple online registration process. Very important. They made clear who has to pay the taxes, who is responsible for the taxes if you go via a platform. So it's clearly defined the platform will be responsible. And last but not least, they also have introduced a platform for regular business exceeding the 150 euro. Coming to the end of my presentation, what is my takeaway for you? What should you look at going global, going more international from a tax point of view? Look at your business needs. Look at what is necessary for you. Don't go for shiny mega structures if you can stay simple. You remember the direct model versus the indirect model. If you can, stay simple. However, keep in mind that your growth might be much faster than you expect. And all of a sudden you have to react, which is taking away the energy and your attention from what you want to achieve. Take taxes into consideration. Look at what potential tax can have for your structure. But don't make your structure just for tax reason, because this will quickly be found out by the government you are doing business in, and they will penalize you for that. Digitization, I've talked about it. Please be aware that the government might be much faster than you, so that you know the exposure, that you have a plan how you digitize your own organization, not only for supply chain, but also from a financial aspect, that you are prepared for the challenges. And I don't have to tell you this, in your area, changes are so fast. So be prepared that also from that angle, much more regulation will come in the future, so that you have a plan also to deal with this. Thank you very much for your attention. I wish you all the good luck for your future business, and see you later.